Hi everyone, David Mailer here, and today we're going to show you simple interest and how to quickly figure it out, and also to get the payments and how much they are and how long it would take to pay off based on a certain type of payment. So let's take a look here. First, we have principal or loan amount of $10,000. Just an average $10,000. We're looking at a consumer loan, an average consumer loan, not necessarily a car loan. So we're looking at 12%. And the term, it could be anything. We're going to look at 15 years. Okay, but this could be 5 years, 6 years, 10 years, whatever. Okay, so simple interest, we got loan start, number of payments. We're going to go through 1 month, 3 months, 6 months, 1 year, 2 years, 3 years, 5 years, 10 years, and 15 to show you. And this is just, how many months are in each of these for payments, right? So obviously in 1 month there'll be one payment versus the loan start, you didn't pay anything yet. That's assuming zero down. Obviously, if you had put money down, that'd be different. Now let's go look at the interest column here. How do we figure this out? So obviously the first, when it starts, is clearly just going to be zero, right? So at 0, 0. But for the first month, what would be the interest? So here it is right here, D7, which is your loan start, $10,000, right? And then it's times B2, which is your percentage, 12%. And then it's divided by the number of months. If it's the end of the year, it would just be this times this without the 12. So since it's the first month, it's divided by 12. That's how we get $100. And then so on down this column. See, it goes from 1 month, 1 of 12, right, to 3 months, which is divided by 4, right, because there's 3 times 4 is 12. This would be divided by 2, see it right there. And 1 year, as I said, would be there's no longer a divided by number there. It's the full number of $7 because we're going down this column here and figuring out here. So anyway, as you go through this, you'll figure out this is the total amount of interest you're going to pay on that loan. So at 2 years, it's $2,400. At the beginning, it's $100, $300, $600, $1,200, $2,400, $3,600, $6,000, $12,000, $18,000. Again, that's for 15 years, and it's assuming simple interest. We're not doing compound interest here. If you want compound interest, I have other videos on that you can watch on this channel. And I may put another one up soon to be similar to this, so you can see them both side by side. So then once you've gotten through this and you figured out what the interest is, you want to figure out what the total payment is, right? So the total payment would be your $10,000, but at 1 month it's going to be $10,000 plus $100, right, to pay it off. If you want to pay it off in 1 month, you got to pay the principal, $10,000 plus your interest, $100, and you pay it off. $10,300. Basically, all this is we're taking the total payment and we're adding the interest to it. See right there, equals $7 again, which is your $10,000 plus C11, which is this right here, the $1,200. That's exactly how we get to each of these all the way through, even down to here at the bottom. Same thing, $7, which is the $10,000 right here. And then what we're doing is adding to it C16, which is right here, $18,000. So we got this column. We know exactly how much the payment is going to be in the end, the total payment, the end payment at that point with the interest. So obviously if you keep it for 15 years, you're going to pay $18,000 interest on a $10,000 loan. It's a lot of interest. Now, let's figure out what would happen, what would be the actual payment to pay this off in 15 years. Now you can figure out what you want here, but this is why I highlighted this column here especially. So obviously at loan start, you have 0 payments. You didn't pay anything yet, not due for 30 days or whatever your bank or loan company has you do, but usually it's about 30 days. And so the next one here, so this one's 0, okay, just like we had here, but now this one is where you have the face value, or future value, future value. So this is the FV formula. So in Excel, so it's the FV equals B2, which B2 is what your interest rate is. So you got your interest rate times $8. So what is that? That is right here. How many payments? So you got interest rate, payments, and then the 156 is coming from where? Let's take a look here. What is that coming from? That's your payment. So that's going to be the same. We're going to pay that payment every month. See, I could change that to anything I want. This is the payment. So again, it's rate. It's the $8, which is the number of payments, right? So what payment it is and the amount. So in this case, this is payment number 1, and it's for 156, and they're all going to be 156, so we're going to go out, as to all the payments. So if we do this, the balance at the end of that one payment is now $9,944. Why we paid $156, but remember, $100 of that goes into interest. That's how we end up with this. You don't get $10,000 minus 156. That'd be nice, but the bank, that's then the bank saying we're giving you 0% interest, not 12% interest. Okay, and it goes through this all the way down. See how I did that? Now it's all it is this equals $8, which is this guy right here, times B9, right? So B9 is this times the numbers, which is 468. See that? So and the reason why is, think about it. We're paying 156 per payment. So this guy no longer needs that future value thing. We could use it, but why? That's only for the first one to get the first payment. After that, we're just doing 3 times 156. We're doing 6 times 156. We're doing 12 times 156. See that? That's how you get these numbers all the way through to here. Then you're going to have 180 times 156. Now what's interesting here is, watch, as you're making your payment. So at 3 months, the next one, you get this minus the 468, right? See that? But it's not just minus 468. See how that comes down to just 98.32? Because why? You've got to take off $300 in interest. See that? So you've got D9, which is here, D9, right there, D9, plus E9, which is this. So that's how you get the 98.32. So you've made that many payments at this point, okay? See, so it's not 156, it is, but behind the scenes, we're showing you at 3 months. So you're seeing this with 468 and 10,300, and that equals 98.32. So you can see how the balance drops faster as you get farther along. Obviously, in the first 3 months, first 3 it's just by month, basically. But as you get here, and then towards the end, at the end of 15 years, you've got a minus 80. What that means is it actually cuts off before the very last payment, okay, or part of the last payment. You don't need to make the whole 156 in the last payment because we picked 156. So you would make minus 80 from that, which would be 76, right? So that's, you would have to, their last payment would be, less money. It would be $76 out of the last payment for the 15 years. So that's basically how you do simple interest, because you could easily just go in here and figure out a quick future value based off of this formula. You could go get the rate, and you could go get your term, which is what payments, how many payments you're going to make, and what the payment is. Okay, that's what the future value equation or formula is. But by doing it this way in a chart, it makes it very simple. You can see exactly how many payments. I could do every month out and have a big long chart, but I want to show you monthly, quarterly, half year or biannually, and then by year, and then show it to you at the end as to how many payments it would take. And you can see it right here, 180 at 156, and you'd be paid off on that $10,000 for 12%. That's how it works. That's all the formulas we have in here. Most of these are just very simple formulas. So like in here, $7 would be here was your loan start, okay? Times $2 is your rate. So you've got that times rate divided by the term, which is 12, right? So you got 12 months versus here, 4, remember that, and 2. So again, this is the biggest formula you have in here, is using the future value. And then again, that is your rate, number of payments, and the payment amount. Okay? If you have any questions, let me know. Put a comment down below. This is some very interesting stuff. It's great for home mortgages, and you're doing your home budgeting and figuring out loans, and if you're trying to get into a business or whatever it is you're trying to do, so you know how much money you have to pay out and how long you have to pay it for. Obviously, if you change this to $300 a month, it would not go out this many years at all. And you would pay a lot less in interest because you're paying it off quicker, but you're going to pay more money. So that's, the pluses and the minuses here. Anyway, are the pros and cons. This shows you exactly how to get a chart that shows simple interest based off of the principal of $10,000, a rate of 12%. You could pick anything you want with these formulas, and the term of 15 years. And then you just plug it in and build it just like this, and it shows you exactly how much money you would end up paying and how long it's going to take to pay that off. Thanks again for watching. I hope you found this interesting and informational, and have a great day.